Dear Vas, dear all, thank you. Thank you for inviting me to speak on tokenization and the future of finance. It is a pleasure to be with you to discuss this very important topic for the financial system as a whole and for central banks in particular. In my presentation today, I will first provide some context on tokenization and the digital asset landscape. I will then discuss the opportunities and the risks. Finally, I will explain the role of tokenized central bank money can play to maximize the opportunities and minimize the risk. Can I have my slides on? The second one, please. Let me start by saying a few words of introduction. It is important to distinguish between the technology behind tokenization and its various applications. One point I want to emphasize today is indeed that the benefits of tokenization can be achieved in more than one way. This has important implications if we want to maximize these benefits while avoiding unwarranted risks to the financial system, such as instability or fragmentation. At the core of today's discussion is tokenization. But what is new about it? Digital representation of assets have been around for a long time. Hardly anyone trades bonds or equities in paper format anymore. What is new and transformational indeed is the process of converting or issuing assets as programmable tokens using decentralized ledger technology, which allows information to be shared and kept synchronized across a network. Tokenization allows programmable tokens to carry two sets of information at the same time. First, the information about the asset itself, that is, who can hold it, how it can change ownership. Sorry. The first is the information about the asset itself, which is on the left. What it is, who has issued it, who holds it. And second, the rules, what is in the right. That is to say, who can hold it, how it can change ownership, as well as complex rule compiled into what we call a smart contract. Can I have the next slide, please? The tokenization has the potential to enhance efficiency. It could allow market participants to handle trading, settlement, and custody on a single platform 24 hours a day, 7 days a week, 360 days a year. I trust that my slides are on because I cannot see from here. Smart contracts automate and speed up processes between issuer and investors, reducing transaction failure and reconciliation needs. Moreover, a shared DLT platform could make it easier for small and medium-sized enterprise to access capital markets. Can we move to the next slide, please? So what kind of digital asset exists? Like conventional asset, we can distinguish two broad categories of digital asset as described in these slides. First, asset whose main purpose is to make payments and settle claims. This includes central bank money for digital transaction, tokenized deposit, and stablecoins. And second, the asset that are held as investment, but also to hedge or make directional bets. This can be tokenized representation of assets that exist in the traditional world, such as bonds, equities, and commodities. But there are also unbacked crypto assets, which are assets that have no intrinsic value, do not generate income streams, and are no one's liabilities. Next slide, please. Actually, we can move to the next one. I will now turn to the opportunities and the risk of tokenized assets. The Eurosystem has long been supporting the development of a European market for digital assets. The reason is that the development of this market is key to preserving sovereignty and fostering innovation. So we need to keep this market in Europe, and have it based on European infrastructure, euro-denominated settlement asset, and the EU-wide regulation. Such an approach is consistent with the achievement of the objective of the Saving and Investment Union, and it will protect strategic autonomy, monetary sovereignty, and financial stability. The question is thus not whether we should embrace digital innovation. Clearly, we should. The key question is how can we best support the development of this market while avoiding undesirable side effects. Can we turn to the next slide, please? You may ask, why should the central bank care? There are two main reasons. First, tokenization could reconfigure the monetary system. The central bank needs to ensure that in the new tokenized world, central bank money continues to play its anchoring role. Second, some aspect of the tokenization can have profound implication for the intermediation capacity of banks and therefore for monetary policy transmission and financial stability. Next slide, please. In this digitalized financial ecosystem, what should be the role of private settlement assets? Let me start with tokenized deposit. Tokenized deposit can exist in a bearer form that is transferable or in a non-bearer form that cannot be transferred outside the issuing bank. The two types present an important trade-off. On the one hand, non-bearer tokenized deposit are safer as their price cannot deviate from par. On the other hand, moving non-bearer funds across banks require a settlement platform that is not easy to establish. Can we move to the next slide, please? Let me now turn to stablecoins. There is a lot of talk about stablecoins potential, which is sometimes confused with the potential of tokenization. Their expansion up to now has been driven by the growth of unbacked crypto trading, as stablecoins are used as a settlement asset for this transaction and as an on and off ramp between crypto and fiat currency. Further growth opportunities for stablecoins may come from the use in cross-border payments or as a store of value in jurisdiction with less stable currencies. But stablecoins also have some important limitations, such as fragmentation of liquidity, risk to bank intermediation, and the limited elasticity of stablecoin supply due to the 100% reserve ratio. In these slides, you can see that some features amplify this risk and some other mitigate the risk. The amplifying risk have the red color, the mitigation, the blue color. Starting from the currency dimension on the left, euro-denominated stablecoins on DLT rails could add a layer of resilience in the EU. At the same time, the expansion of foreign currency-denominated stablecoins could undermine strategic autonomy, monetary sovereignty, and possibly the international role of the euro. Moving to the jurisdiction, issuance in the EU could strengthen our strategic autonomy and reduce AML CFT risks associated with stablecoins. On the other hand, third country issuance expose the euro area to risk of regulatory arbitrage and runs originated elsewhere. Finally, Stablecoins, including when issued by banks, lack the benefit of fractional reserves and lead to outflow from stable retail bank deposit, and issuance by non-banks could weaken bank intermediation. Next slide, please. The risk I just highlighted call for robust regulation, and these slides provide a stock take of the suggestion target amendments to the MiCA regulation. The first area is EU-wide consistent supervision, including centralized supervision of significant crypto asset service providers and enhanced and standardized data reporting. Second, regulation must address the risk related to multi-issued stablecoins as outlined in a recent recommendation of the European Systemic Risk Board. Finally, there is the need to review the limits on the use of non-EU currency-denominated stablecoins as a means of exchange, which aim to protect euro area monetary sovereignty. Currently, these limits are very narrow defined. For example, they only consider specific transactions and do not limit holdings. Next slide, please. Let me turn now to the Eurosystem strategic response. Our vision is that tokenized central bank money can play a key role to seize the opportunities while reducing the risk associated with digital assets. Next slide, please. Tokenized central bank money would provide a risk-free settlement asset to the digital asset ecosystem. This should support the development of a European digital asset ecosystem, including for private settlement assets. There are three reasons for this. First, the safety and reliability of central bank money settlement provides market participants with the confidence needed to invest in digital asset initiatives. The market feedback we have received is that settlement in tokenized central bank money is needed to catalyze the issuance of digital assets. Second, central bank money can be scaled up to fulfill the settlement needs of the market. Third, central bank money can act as a connector across private settlement assets. This is a key condition for establishing an integrated European market for digital assets from the outset. Next slide, please. In the Eurosystem, we already moved toward meeting the needs of for tokenized central bank money. In 2024, we conducted trials and experiments using 3 different solutions to ensure interoperability between our infrastructure and market DLT platform. Next slide, please. Our exploratory work on a wholesale DLT settlement was the largest and the most comprehensive in the world today. More than 60 industry participants were involved in the real and mock transaction. A wide range of security and payments use cases were covered. A total of 1.6 billion was settled over a 6 months period. We have published a report on the key findings last June. Next slide, please. Building on this work, we have launched Project Pontes with the aim of delivering a regular services for settling DLT transaction in central bank money as early as the 3rd quarter of next year. We are also working on Appia, a long-term vision for an integrated European digital asset ecosystem. The launch paper for this vision will be published early 2026. Next slide, please. So how will it work? Ponte's project will provide a bridge between DLT platform and our existing target settlement services, enabling delivery versus payment and supporting innovation. We also aim to gradually enhance Pontes with new functionalities following its launch. For instance, by offering 24/7 operation and settlement, or by enabling the market to deploy automated smart contract directly on the Eurosystem DLT. Next slide, please. With Appia, we aim to put central bank money, asset, and private money on the same platform. To do so, Appia will assess the potential of a shared ledger interoperability between DLT platform or a combination of these approaches. It will also explore the international dimension to support cross-border settlement. Appia will seek to support interoperability, standardization, and competition in the new ecosystem. And it will aim to address the current fragmentation along the entire financial market value chain. Let me conclude. We should embrace new technologies to prepare the future of finance. The financial ecosystem of tomorrow is likely to host multiple forms of money, but the stability and the integration of that ecosystem relies on offering tokenized central bank money. This will help delivering the expected benefit from tokenization while reducing the risk. Thank you very much for your attention.
That's great, Piero. Thank you so much, and I hope you could hear the applause. I don't know if it could come through. So we've got about 10 minutes or so for questions. While people are thinking, I might start with one, and then we can open it up. I mean, Piero, you mentioned actually, as you know, the use of tokenization, the exploration of distributed ledger technology in finance is being explored across the world. But there are some slight differences in terms of the approach that different jurisdictions are taking, whether that is in terms of some of the regulatory frameworks or in terms of how central banks are approaching it. So how do you see the Eurosystem's approach compared to that of other jurisdictions?
Thank you, Vas. I mean, indeed, there is a lot of exploration going on. As you can imagine, anytime there is a new technology and a new opportunities, there is a blooming of initiative around the world. And as you said, we saw different innovation or initiative on several grounds. One ground is the regulation, which is more in the remit of public authorities. One dimension is at the foundation layer. I mean, layer one. And the other dimension is at the application layer. So you have many initiatives, but broadly you can classify them along these three dimensions. Let me say something on the regulation, which might be the one that people are more familiar with. So far, there are just 2 jurisdictions around the world that comply with the FSB recommendation, which is the Eurosystem and Hong Kong. Other jurisdictions are partially compliant or in the evolution. The most known of this regulation is the Genius Act. The Genius Act regulates essentially the issuance of stable coins. The major difference compared to the euro area, I would say, will rely on 2 things. One on the safeguard, and one not the safeguard, the reserve. Where do you put your reserve? And the second one has to do with the rights of the customer when they have to redeem. So in the euro area, customer, the user have the right to redeem at the pair, while in the US, they foresee the possibility of a redemption fee, which could be changed by the issuer anytime. This might create some arbitrage opportunities which I was referring at my speech. The second important dimension is what you do, what issuer of stablecoins can do with the reserve. In Europe, as you might know, there is a requirement that 30 or 60% of the reserve had to be parked in the banks, and this is a requirement, 30 or 60, depending whether the stable coins is systemic or not. In the US, there is the possibility to deposit part of this reserve at the central bank. And in a recent speech, one of the governors has hinted to that. The Fed might create a skinny deposit scheme to allow stable coins to deposit this. Those are two complete different framework, as you can imagine, because essentially in the second case, in the Genius Act, essentially you could create a hybrid or a synthetic CBDC. It seems to me that the UK is going more or less in the same direction, where they allow also stable coins to deposit their fund, systemic stable coins, as they call it at the central bank. We think those are have profound implication for the role of the banks as an intermediary in the system. Our approach is to preserve the centrality of central bank money as the anchor of the system, and we have some concern about the possibility that there is disintermediation of the banks in their lending capacity to the economy. Let me stop here.
Thank you, Piero. I've got a couple of questions online already, but just to check if there's anyone in the room that might want to ask Piero a question. No, I don't see anything. So the couple that I've got online, one we kind of covered a little bit, but one of them is the ECB worried that some of these solutions might come to market too late? So how are you thinking about the timing of this? And the other one, it's about the kind of comparison of the Eurosystem and other jurisdictions again, but I think it's more specific. I mean, he talks about CBDCs. Why is the Eurosystem pushing ahead with CBDC when other central banks see the value of private sector solutions and are taking a slightly different approach to CBDCs?
Let me answer the first question, whether we are coming too late. It seems to me that at this point in time, the Eurosystem is pretty advanced in providing this solution. I'm trying to, as I said, Q3 2026, we will have in production the possibility for those that trade asset on DLT to rely on central bank money. I don't see any other jurisdiction, maybe the Swiss, that are at this point. But we are in production 2026. This means that essentially you provide liquidity to this market and therefore allow this market to trade in a safe way. The alternative would be that stable coins replace central bank money, but stable coins are stable up to a point. And in any case, so this is the first problem. The second problem is the fragmentation of liquidity, because you might have different platform, different stable coins which cannot be moved from one platform to another. Third, the scalability, as I tried to say, stable coins, because of the 100% coverage, they are not easily scalable when liquidity is needed. That's why central bank more is so important, because it doesn't suffer of these three problems I just mentioned. And in fact, Market operators are well aware of that. In our discussion with the market, they are pushing us to move fast to provide them with this solution because they realize that central bank money is essential for an healthy development of this market. Again, we are not excluding at the euro system that private money will play a role in this new system and this new ecosystem. In fact, as I tried to explain, we are envisaging Appia as an ecosystem where on the same platform, one or more than one, we will foresee the coexisting on the same platform of private money, public money, and asset. Very much as you can imagine today, right? Today you can trade your asset and you can settle your asset by using central bank money or commercial bank money. We have to think, and the system works pretty well, we need to think how we replicate the safety and the security of the system we have today while reaping the benefit that can be provided by the DLT, which allows many things that the current solution do not. So we have just to adjust or rethink a little bit the way we do important things that we do today in a different ecosystem, and that's what we are doing.
Very good, perfect. Maybe I've got time for one more question. Don't see any in, oh, there's one over there, yeah. There's a microphone that's coming, yeah.
Hi, thanks very much. My name's Piero. The number of people who live in a country which uses the euro is about 350 million. America's population is about 350 million. Why does the ECB see multi-issuance stablecoins as a risk when an equivalent-sized economy doesn't?
We just look at the regulation, and we see that there might be. Let me give you an example, a simple example. If MiCA does not allow you to have redemption fees, while the Genius Act allows you, so there is a clear arbitrage. There is a clear arbitrage opportunity here, which means that the reserves that the issuer in Europe, the issuer of a non-euro denominated stablecoins in Europe, has a reserve that is proportionate, actually is 1-to-1 or a little bit more of the liability of the token issued in euro. But because of the fully fungibility, everyone from the rest of the world can come and redeem in euro. And if there is an arbitrage condition there, the probability that this happens is very high because there is an opportunity for arbitrage. So we are not scared in principle. What we are saying simply is that we need to make in place safeguard that prevents, the possible that someone take advantage of this regulatory arbitrage to bring possible financial instability in Europe. That's all. It's just a matter of, you cannot call fungible something that is not fungible because it is rooted in a different set of rules. If they can be technically fungible, it's not equivalent from, an economic point of view. And if this is the case, then, there is an intrinsic possibility of instability here. That's all.
Very good, Piero. Thank you so much. I think we've reached the end of the time for this, but it set us up really well for the panel discussion. I saw there was actually another question about stablecoins, so I'm sure we'll cover that as part of the panel discussion. But please join me in thanking Piero for joining us here today. Really appreciate it.